Hey everyone, welcome back to Financial Futures. I'm thrilled to have you here today because we've got some major news. The August CPI inflation report has just been released, and guess what? Inflation has fallen to its lowest level since February 2021. Yes, you heard that right. We're looking at a significant drop in inflation, and all eyes are now on the Federal Reserve. Will they cut interest rates at their upcoming meeting in just 7 days? All signs are pointing toward a yes. Let's break down the numbers and discuss what this means for you. Let's start by diving into the official CPI report for August. Inflation has dropped to 2.5%, the lowest rate we've seen in more than 3 years. This is a big deal because it signals that the aggressive rate hikes we've been experiencing are finally having the intended effect of cooling down inflation. Now, let's take a look at core inflation, which excludes volatile food and energy prices. Core inflation is at 3.2%. While that's still above the Federal Reserve's 2% target, it's much lower than what we've seen in recent months, and it's a clear sign that inflationary pressures are easing. Energy prices saw a 4% decrease, which is a relief for consumers filling up at the gas pump. However, food inflation remains slightly elevated at 2.1%. Shelter costs, which have been a major driver of inflation, are still up 5.2%, but this is also showing signs of deceleration. With inflation trending down, the big question is, what will the Federal Reserve do next? The markets are currently betting that the Fed will cut interest rates at their next meeting, which is just around the corner on September 18. And I have to say, based on the numbers we're seeing, this seems very likely. Let's talk about the CME FedWatch tool, which tracks market expectations for Fed rate moves. Right now, there's an 85% chance that the Fed will cut rates by 0.25% and a 15% chance that they might go even further with a 0.5% cut. If you've been following my channel, you know that I've been predicting a 0.25% cut, and that's looking more and more like the direction we're headed. So, what does this all mean for you and your finances? When the Federal Reserve cuts interest rates, it tends to have a wide-ranging impact across the economy. Let's break down a few key areas where you'll likely see changes. First, borrowing costs will start to decrease. That means lower interest rates on mortgages, credit cards, auto loans, and student loans. Lower interest rates also typically boost the stock market, as companies can borrow money more cheaply to invest in growth. This could be good news for your retirement accounts or investment portfolios. But remember, with rate cuts also comes the potential for a weaker US dollar, so there's a balancing act here. This rate cut isn't expected to be a one-time thing. The market is forecasting that the Federal Reserve will continue cutting rates through the end of the year and possibly into 2025. This would mark a significant shift from the rapid rate hikes we've seen since last year, and would usher in a new era of monetary easing. In the long term, rate cuts could help spur economic growth, but there's also the risk that inflation could start rising again if the Fed isn't careful. The challenge for policymakers will be to strike the right balance between supporting growth and keeping inflation under control. Now, let's get into the details of the latest CPI inflation numbers so you can see exactly where we stand. Overall CPI inflation, 2.5%. Core inflation, excluding food and energy, 3.2%. Energy prices down 4%. Food inflation, up 2.1%. Services inflation, 4.9%. Shelter inflation, 5.2%. So while inflation is cooling, you can see that certain sectors are still seeing elevated price increases, particularly in services and shelter. Several key Federal Reserve officials have been speaking out about the current economic situation. For example, Chicago Fed President Austin Goolsbee recently mentioned that while inflation is easing, we're starting to see signs of weakness in the labor market. He believes that the Fed will need to continue cutting rates over the next year to support the economy. Similarly, Atlanta Fed President Raphael Bostic has indicated that waiting until inflation hits the Fed's 2% target before cutting rates could be risky, as it could harm the labor market even further. Both of these voices are shaping the narrative that more rate cuts are likely on the way. As inflation eases, we're also seeing some troubling signs regarding household financial stress. According to recent data, household income is expected to grow by 3.1% over the next year, but spending is projected to rise by 5%. This mismatch between income and expenses is increasing financial pressure on many families. Some analysts are even starting to talk about the potential for deflation, where prices actually start to fall. While that might sound good in theory, deflation can be dangerous for the economy, as it can lead to reduced consumer spending and lower business profits. If deflation becomes a serious concern, the Fed may have to resort to more aggressive measures like quantitative easing to boost inflation again. So, what can you do to prepare for these upcoming changes? First, if you're planning to make any big purchases, such as buying a home or a car, it might be worth waiting until after the next Fed meeting to see if interest rates come down. Lower rates could save you thousands of dollars over the life of a loan. Second, keep an eye on the stock market. Rate cuts tend to boost stock prices, but if inflation starts rising again in the future, we could see some volatility. Stay informed, diversify your investments, and make sure you're prepared for potential ups and downs. To sum it all up, inflation is down, and the Federal Reserve is likely to start cutting interest rates very soon. This will have major implications for your finances, from your credit card interest rates to your mortgage payments, and beyond. I'll keep you updated as the situation evolves, so be sure to subscribe to Financial Futures and turn on notifications so you don't miss any important updates. Let me know in the comments what you think the Fed's next move will be. Do you think we'll see a 0.25% cut, or will they go bigger? Thanks so much for watching. Stay informed, stay prepared, and I'll see you in the next video with more financial news that affects your future. Take care.